Today's the 5th of July 2021. If you are in the United States, I hope that you had a happy Independence Day. My name is David Hickson, and in today's market update, I'm going to be speaking about something called time translation, which is a result of the way in which cycles combine to influence financial markets. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. So for the sake of continuity, I am going to be taking a look at the S&P 500. This is the analysis that I have been speaking about for several months, actually, in these market updates. And as you know, I am still expecting an 18-month cycle trough to form. That cycle trough we have been expecting to form sometime in July. At the moment, it's looking like it could be late July. Is it possible that that 18-month cycle trough has already formed? Has it sneaked past us? Yes, it is possible. And that is something that I discussed in last week's market update. I'm going to be revisiting that subject in today's market update. And I'm going to be speaking in particular about a concept called time translation. So how is it possible that a trough of 18-month magnitude could sneak past us? Most people would imagine that a trough of 18-month magnitude must be a really big affair. We would expect prices to move down for about 9 months in order to reach the 18-month cycle trough. And that is one of the big misconceptions about the way in which cycles combine to influence financial markets. For several months in these market updates, I've been discussing the approaching 18-month cycle trough, and I have also mentioned many times that I do not expect the move into the 18-month cycle trough to be a very big dramatic affair. And we have taken a look at the composite model lines and things like that, and many of those composite model lines have indicated a bit of a sort of a flat line with perhaps a bit of a decline into that 18-month cycle trough, which is why it is possible that the 18-month cycle trough has indeed formed. I'm going to be taking a look at some possible analysis alternates in a moment, but let's discuss how it is possible that an 18-month cycle trough could sneak past us without really being observed. And at the heart of this concept is the idea of time translation. So what is time translation? Well, as you know, a financial market is influenced, according to the ideas discovered by Hurst 50 years ago, by multiple cycles. Each one of those cycles can be displayed as a simple sine wave, which is a way of representing the cycle. So let's do that here in this particular analysis. This line displayed here on the chart is in fact a sine wave representation of the 80-day cycle that has been found in this analysis. As is to be expected, the cycle looks fairly regular. In other words, it moves upwards for about half the duration of the cycle, and then it moves downwards for the next half of the duration of the cycle. And that situation repeats fairly regularly. That is how we know cycles to work. But how is it that such a regular sequence of up and down influences ends up looking so messy and sometimes unidirectional as the recent price action that we have observed? And that has to do with the way in which these cycles combine. We know that there are multiple cycles that are constantly influencing the price action of these markets. Let's zoom in here for a moment and consider only one of these 80-day cycles. Here you can see the 80-day cycle trough that has been found in the analysis, and the next 80-day cycle trough, which was also, of course, a 40-week cycle trough over here at the end of October. This cyan-colored line indicates the influence, if you like, of the 80-day cycle over that period of time, and it does indeed move up for about half the period of time, and it moves downwards for the second half of that period of time. Now, the peak of the 80-day cycle itself is over here. But what happened as the 80-day cycle was peaking? Well, price was actually forming a low point. This is one of the reasons why many people speak about the idea of cycle inversion, because when a particular cycle is expected to peak, we will sometimes see a trough forming in the market. According to Hurst's approach, the reason for that is because of the fact that the 40-day cycle was forming a trough at that time. And so there is no cycle inversion. But what happens is that the peak in the cycle is not in fact a peak in price. So where is the peak in price? Well, the peak of this particular 80-day cycle is of course the highest price, which is over here, which is well displaced from the peak of the cycle itself. One might argue that this is also a peak of the 80-day cycle. It was not quite as high as the earlier peak, so it is probably not the correctly positioned peak of the 80-day cycle, but one could argue that that is also a peak of the 80-day cycle. Both of these peaks, as you can see, are displaced from the actual cycle peak. And the reason for that is because of the way in which the multiple cycles combine. We can visualize this very simply by displaying more of those cycle lines here at the foot of our chart. And by combining the various influences of the different cycles, we end up with a resultant price action. Here you can see that this first peak was fairly close to the peak of the 40-day cycle. It was also displaced. Why was that? Perhaps it was displaced because of this 20-day cycle, which was over here. And so the actual peak in price occurred between the 20-day cycle peak and the 40-day cycle peak. Now, taking a look at these cycle lines at the foot of the chart can still be fairly difficult in terms of visualizing how those cycles are influencing price, which is where a tool such as the composite model line becomes useful. There is a composite model line that combines only 3 cycles, the 10-day, 20-day and 40-day cycles. The resultant influence of those 3 cycles is shown in the dashed orange line. You can see here how the composite model line shows quite clearly the idea that these peaks will be time translated. They will be displaced from the peak of the actual cycle. And so what does this time translation mean in terms of our anticipation of an 18-month cycle trough? Well, recently, as you can see, price has been moving upwards. As a matter of interest, I still favor this particular analysis because I'm not, of course, only watching the S&P 500. I would encourage you to take a look at other markets such as the FTSE, the DAX, and even the South African market and some emerging markets which show a slightly different picture. The S&P 500 and most other US markets have been particularly bullish, but other markets around the world have not been as bullish, which increases my confidence, if you like, in the idea that the 18-month cycle trough still lies ahead of us. Nevertheless, how is it possible that price keeps moving up when we are expecting such an important cycle trough to form? And the answer to that is in time translation. The rule is very simple. When a market is bullish, we expect peaks to occur late. And when a market is bearish, we would expect peaks to occur early. Now, it is no surprise that this market has been bullish. Of course, I believe that there was a 54-month cycle trough that formed in March of 2020. It might even have been a longer cycle trough, such as the 9-year cycle trough. But let's, for now, just focus on that as being a 54-month cycle trough. The fact that the 54-month cycle is now moving upwards from that trough is providing a great deal of bullishness to this market, which means that we expect peaks to occur late. As a matter of interest, it also means that we expect troughs to occur early. So the concept of time translation explains why it is possible that the markets are still rising up even though we are expecting a trough of a fairly large magnitude cycle to occur. Now, as I've mentioned, this is still my preferred analysis. In other words, I am still expecting the 18-month cycle trough to lie ahead of us. But is it possible that it lies behind us? Yes, it is possible, and I'm going to show you an analysis that actually shows that possibility. Here is that analysis, and you can see these pinned symbols at the foot of the chart which show that I have influenced the analysis. I have asked Sentient Trader, if possible, to position those troughs in those positions, and it has obliged. The result of this analysis is, as you can see, that Sentient Trader is telling us that it is possible that the 18-month cycle trough occurred here at the end of June. This little trough over here. Now, I describe it as a little trough, and if we zoom in, you can see that the number of days over which price moved down into this potential 18-month cycle trough was a disappointing 4 days, and let's allow it a bit of time over the weekend, so perhaps it moved down for 6 days into this 18-month cycle trough. Surely that must be impossible. Well, no, in my opinion it is unlikely, but it is not impossible. because of the concept of time translation. When we have a lot of bullish pressure, peaks will occur very late. So now, is this the correct analysis? Does this mean that the 18-month cycle trough has occurred? In my opinion, this is not a very good analysis, and let me show you a few reasons why I have not been speaking about this analysis in previous market update videos. The first reason is this 20-week cycle trough over here from the end of October until early February, which elapsed over only 94 days. The average length of a 20-week cycle is 136 days, and so this is a very short 20-week cycle. Many analysts would say an impossibly short cycle. And in fact, if you go back and take a look at the market update videos in early February, you will see that I did discuss the possibility that this 20-week cycle trough was forming at that time. I received a few emails from some very experienced Hurst cycles analysts telling me that in their opinion I was entirely wrong, and of course now I do agree with them. I do not think that was a good position for the 20-week cycle trough, but it is still possible, and I do think it's important to keep an eye on different analysis possibilities. If all this talk of different analysis possibilities is confusing you, I would encourage you to stay tuned, because in a moment I'm going to, I hope, demonstrate to you, as I did in last week's video, why we can still make confident trading decisions despite the possibility of different analyses. And so that short 20-week cycle is, in my opinion, a good reason to treat this analysis with a pinch of salt. Another reason why I am not very impressed by this analysis has to do with the interaction between price and the 40-day FLD. Now, you know that I track a fairly reliable sequence of interactions, and here is this sequence. According to this analysis, following the 20-week cycle trough over here, we have our A category interaction, which achieved its target and exceeded it. Nothing wrong there. That looks like a good A category interaction. However, the B category interaction, which forms when the 40-day cycle trough is forming in the market, should find support at the level of the 40-day FLD. In this case, it did no such thing. It in fact crossed below the 40-day FLD, generated a target, achieved it, and then bounced back up again. That does not look like a good and clear B category interaction. So I would put a definite question mark there. The C category interaction usually occurs when price bounces away from the FLD. In this case, it actually crossed the FLD. So again, not a very good and clear interaction between price and the FLD. When the 80-day cycle trough forms in the market, we should witness a D category interaction as price comes down, forms the 80-day cycle trough, and then bounces back out of it. Where is this 80-day cycle trough? It is over here. That is a very big question mark for me. I don't like this analysis at all, I must be honest. The D category interaction is simply impossible to identify, and the E category interaction is also impossible to identify. This would be our F category interaction over here, where price did actually come down and achieve its target. So that looks fairly good. But what about the G category interaction, where price finds resistance at the level of the FLD? Well, again, that didn't really happen, did it? Price broke up above the FLD. It dropped down below it over here to form this final trough over here. So for all of those reasons, or for the reason that this FLD sequence is really not clear at all, as well as the fact that we had a very short 20-week cycle, I believe this is not a very good analysis. In last week's market update video, I also presented to you the default analysis that Sentient Trader has performed, and this is still looking to be a very good analysis. Here you can see that the trough that we are still expecting to lie ahead of us towards the end of July is only a 20-week magnitude trough and not an 18-month cycle magnitude trough. Now, one of the reasons why I am not very keen on this analysis also has to do with the concept of time translation. If we measure this 40-week cycle over here, you can see that it elapsed over 346 days. The average length of a 40-week cycle is 272 days. 346 days is very long for a 40-week cycle. Now, I've already explained that according to the idea of time translation in a bullish market, we would expect troughs to occur early and peaks to occur late. So why is this trough of the 40-week cycle occurring so late in what has clearly been a very bullish market? That raises question marks around this default analysis as well. And so it is for these reasons that I continue to believe that this is my preferred analysis. But now, what about the fact that we've got so many possibilities and perhaps the 18-month cycle trough is formed, although I think it's unlikely, but how do we make confident trading decisions? Here I am going to repeat some of the material that I discussed in last week's video because it is really very important in my opinion. Even when we have uncertainty surrounding a Hurst cycles analysis, we are still able to make confident trading decisions on the basis of the way in which price interacts with the cycle tools. Of course, my favorite is the FLD. And I have presented the sequence of interactions in previous market update videos, so I'll just go through it again quickly here. This is the A category interaction, in my opinion. Here is the B and C category interaction. Notice how price found support at the level of the FLD at the time that the 20-day cycle trough was forming in the market. That's B and C. Here is the D category interaction where price came down, crossed below the FLD and found its target or achieved its target at the same time that the 40-day cycle trough formed in that market. Here is the E category interaction. What do we expect from an E category interaction? We expect price to come up and achieve its target. What was the target for this particular interaction? I mentioned it in last week's video, although I mentioned it in passing. It was at a level of 43.45. And so last week's fairly dramatic upward movement in the S&P 500 was not particularly unexpected because we had our target for the E category interaction at that level. It achieved that level on Friday. Now, the fact that it has achieved that level does not necessarily mean that it's immediately going to turn down. It could continue upwards. However, at this point, we do have increasing bearish pressure, and at some point, despite time translation and the fact that we are expecting a late peak to form, we should start seeing price moving down into the 18-month cycle trough. Now, what happens if this analysis is wrong? I've already mentioned that we have some analysis uncertainty, and yet we have confidently placed a long trade on the basis of this E category interaction. But what if the other analysis is correct, and at the end of June, we did experience the 18-month cycle trough? What would that have meant in terms of our trading? Well, if that was the 18-month cycle trough, and at the time I certainly was not looking at that analysis very closely, but if that was the 18-month cycle trough, then this would not have been an E category interaction, but an A category interaction. It is in fact the same trade. It is also a long trade that is taken as price crosses above that FLD. Here is the big difference, and this is how we are going to know what is actually happening in terms of the formation of this 18-month cycle trough. If the analysis that we see at the foot of this chart is correct, then the next interaction with the 20-day FLD must be an F category interaction where price crosses down below the 20-day FLD on its way down to this trough. If, however, the 18-month cycle trough does lie behind us, a possibility that we should keep in mind, then we would expect the price would come back to the 20-day FLD and it would find support at the level of the 20-day FLD in a B category interaction. I do hope that this video has helped to demonstrate how even when we have some uncertainty surrounding the analysis situation, we are able to make clear trading decisions, and we can use the cycle tools, in particular the FLD, to help us to resolve the analysis situation to gain greater clarity in understanding what is happening in the markets. I do hope that you found this market update interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.